Hello and welcome, everyone. Today is a huge day for the markets. We've got two massive competing stories that are about to collide. And honestly, what happens today could really set the tone for the rest of the year. So let's get right into it. So, why is everyone on Wall Street glued to their screens today, March 18th? Well, it's because we're watching this incredible split screen play out in real time. On one side, you have these big, scary global economic headwinds. And on the other, you have this tech boom that seems to be completely ignoring all the flashing red lights. So first, let's talk about that big gray cloud hanging over everything, the macroeconomic pressure. A new global headwind has popped up, and it's making a lot of people pretty nervous. And geopolitics has just thrown a major wrench in the works. The conflict over in the Middle East has sent oil prices through the roof. We're seeing Brent crude, which is a huge global benchmark, trading at over $100 a barrel. And believe me, that's not just a number on a screen, it's a shockwave that's about to hit the entire global economy. And that shockwave, it just ripples out everywhere. See, higher energy prices don't just mean you're paying more to fill up your car. It's so much bigger than that. It means it costs more to transport literally everything, which, you guessed it, leads to higher food prices. It means your heating and electricity bills go up. And just like that, those fears of stubborn, persistent inflation that we all hoped were in the rearview mirror, they are roaring back to life. All of this pressure points directly to one place, the U.S. Federal Reserve. And right now, they're in an incredibly tough spot. Seriously, some people are calling it a dual mandate nightmare. The Fed's job is basically to do two things: keep prices stable and keep people employed. The problem? Right now, those two goals are pushing in completely opposite directions. And this slide just lays out that conflict perfectly. Look, on the one side, you've got surging oil and these renewed inflation fears. That's basically screaming at the Fed, hold rates high, maybe even hike them. But then you look at the other side, and the job market is starting to look a little shaky. The economy actually lost 92,000 jobs last month. So if the Fed keeps rates high to fight inflation, they risk making the economy even weaker. What do you do? And because of this, market expectations have just been turned on their head. A few months ago, everyone was betting on multiple rate cuts this year. Now? Well, as this quote from a top economist at EY Parthenon says, we might only get one. And he says it's entirely plausible we get no rate cuts this year at all. That is a massive shift. This is exactly why the entire financial world is obsessed with something called the dot plot, which comes out today. Think of it like this. It's not a decision, it's more like a sneak peek. It's a chart where every Fed official anonymously puts a dot where they think interest rates are going to go. It's really the closest thing we have to a roadmap of what they're thinking. Okay, so what could this dot plot actually mean for your money today? Here are the three most likely outcomes. Scenario 1, a dovish surprise. If the dots show 2 or more cuts are planned, watch out. The market could rally hard. Scenario 2, the neutral, expected outcome. 1 cut is signaled, and the market kind of just chills out. But Scenario 3, the hawkish surprise. If those dots show 0 cuts this year, we could be in for a pretty significant drop. The stakes today are incredibly high. But okay, take all that macroeconomic doom and gloom and just put it on a shelf for a second. Because while all of that is going on, a completely different story is unfolding. Let's forget the fog and talk about the micro boom, where a single company can shine so bright, led by the AI revolution. And the poster child for this whole movement is Micron Technology. These are the guys who make the super important memory chips that are the brains behind AI data centers. And here's the crazy part. Despite all the worries about inflation and interest rates we just talked about, this company is absolutely on fire. And here's the proof. Just look at that number. Micron's stock just blasted to an all-time high this week. So while the rest of the market is biting its nails about the Fed, this stock is just shrugging its shoulders and marching to the beat of its own powerful drum.
And here's the why behind it all. Micron reports earnings later today, and the expectations are just staggering. Wall Street is expecting sales to be up 139% from last year. And even crazier, they think earnings per share skyrocketed by 464%. That right there is the insane power of the AI boom visualized in 2 simple bars.
And hey, this isn't just a bunch of retail investor hype either. The big-time financial analysts are all in. You've got major firms like TD Cowen and RBC Capital practically tripping over themselves to raise their price targets for the stock, pointing to incredible demand and strong pricing for memory chips. So what's the secret sauce here? Well, it's actually classic supply and demand. The demand for their memory chips to power AI data centers is just off the charts. That's caused the price of those chips to jump 90% in a single quarter. Micron is basically selling the picks and shovels in the middle of a gold rush, and that is a very, very good business to be in right now.
All right, so let's zoom back out and try to bring these two completely different stories together. What's the big takeaway from this wild day? Well, it's that we're basically living in two different markets at the exact same time.
Today, March 18th, just captures this split personality perfectly. On one hand, the entire market is holding its breath over the Fed and inflation fears. And on the other hand, you have these incredibly powerful, specific trends like AI that are creating superstar stocks that seem to be playing a totally different game by a totally different set of rules. So that leaves us with the big final question, right? In a market that's being pulled in two opposite directions, which story wins? Does the unstoppable force of the AI boom eventually run into the immovable object of macroeconomic reality? Or is this tech wave so powerful that it can just carve its own path, no matter what the Fed does next? That's what we're all waiting to find out. Thanks for tuning in.